Welcome back to Brashonomics on Real Estate Monday. And most people are out there financing real estate, whether it is a home to purchase or an investment property. And since we've already had the discussion about why people probably aren't buying houses this week, being that it's, a shortened week for everybody, some people may be thinking about that investment world so that they can give other people places to have Thanksgiving. Ryan Leopold joins us from Cobalt Mortgage. Now, Ryan, you just heard Sarah talk a little bit about the multifamily world, and you used to teach seminars on financing multifamily properties.
I did.
Well, let's kind of get into that because she had mentioned getting pre-approved as a big piece of that. And I know that's something you would agree with, but then you also have some additional strategies on maybe wealth building that we'll bring Sarah and Glenn back on at the end of the show to either agree with or discuss.
Well, I think there's no doubt on the mortgage side that getting pre-approved is obviously a critical step in the entire process. But I think more importantly to the actual pre-approval start is creating the plan for each individual investor, because every investor is going to be different of what their objective is out of the investment property they're going to buy. And if a mortgage is going to come into play, that plan is really critical. And everybody, like I said at the beginning, everybody's going to be unique and different. That once you get past the pre-approval part, we got to understand what we're getting pre-approved for. And really, at the end of the day, what's the why behind buying investment properties, and how is a mortgage going to play into your overall financial position and your overall financial strategy as you start building your real estate portfolio.
I mean, and that makes a lot of sense, because if you don't have kids, you may not be interested in transgenerational property movement. And if you are just trying to retire, you may be trying to build a full-on retirement income out of it.
And again, I did this I did investor seminars for 7 to 8 years, met with hundreds of clients. And the one consistent thing that I did find is a lot of people's objectives and goals around real estate were just different. And once they understood how all the inner workings of the mortgage side works, the process for investing in real estate, especially if they have never done that before, in some cases it isn't the best strategy for people because they have to know what they're getting into from a management standpoint. It's not always as easy as people think it is. So you have to have the right appetite for being an investor, and you have to learn what that process is. So the mortgage is a huge part of that, but the rest of the strategy is important too.
Well, it's more that life strategy. I mean, you're the life strategy. Is it what you're trying to accomplish?
Absolutely.
And then the financing is kind of, we've called it before, it's a tool that helps you accomplish that. Let's talk a little bit about financing 2 to 4 unit properties and the way they're kind of different than maybe larger buildings.
Yeah, so when you start getting into that, I do want to be a real estate investor, I understand kind of what's going to go into it. I understand a mortgage is going to be a part of it. Then we have to understand that financing let's just say a single family property to a 4-unit property is simply looked at differently than that line in the sand between a 5-unit property and above. So 1 to 4 units is considered kind of conforming financing. You're kind of in that Fannie Mae, Freddie Mac world. So financing a fourplex, in essence, is the same thing as buying a single family home. It's the same general idea with some rules and stipulations to it, but it falls under the same bucket. Anytime you go over 4 units and you get to 5 units and above, now we're talking about kind of more portfolio, commercial-based financing where you're outside that Fannie Mae, Freddie Mac window, and now you're dealing with all the different lenders and what they have for rules when it comes to financing those types of properties. So there's a big difference in kind of when you start this process is knowing are you going to go to the 1 to 4 unit range, or are you going 5 unit and above? And if so, what's the plan going to be around that?
Well, and I think one of the biggest things for people to realize is if you're in that 1 to 4 unit, they're underwriting you as a borrower. When you get above 5 units, they're underwriting the building.
Absolutely.
It's a very different game.
It's way different. That's a really good point. It's way different.
So, okay, let's stick with the 1 to 4 units, because that's what you do.
Right.
And that's what you used to teach seminars on. So as opposed to getting into the large building commercial financing, most consumers are probably more in this 1 to 4 unit bucket of investorship.
Yeah.
How much cash do people need?
I don't know if it's necessarily a cash thing. I think it's more of a down payment situation. And there's different strategies when it comes to the down payment side of things. You can either buy a property, say you bought a duplex, and you lived in one side of the duplex. You can come in as an owner-occupied property and still rent out the other side and still come in with 3.5% to 5% down, depending on kind of if you go the FHA route or kind of the conforming route. If you're just going to buy an investment property, 2 to 4 units, and you're not going to live in it, you're looking at 20 to 25% needed as a down payment. So it's not really necessarily a dollar amount thing. It's more of a percentage-based thing. And we always look in terms of minimums needed, and then we kind of work out the best strategy from there. So if you have 50 grand to work with, we kind of have to work around a strategy of 50,000.
And then also making sure you're not using all of that money as a down payment and putting nothing in the bank or not keeping anything and not being able to, any improvements anytime there's a vacancy.
There is, and Sarah mentioned that too, is you have to have a plan going into this. That does the property need work? Do you need money set aside for reserves for vacancy? Do you need money set aside for the repairs that are going to be needed if a tenant moves out and it's not in great shape? Every time a tenant moves out, you're going to put some kind of money into the property in most cases. And other times, if it's not a great tenant, they don't take a lot of care of the unit, then there's going to be a little bit more. So I think that's where investors sometimes don't plan correctly, is knowing how much money they're really going to need outside the normal down payment and costs of doing a mortgage.
Yeah. We're here with Ryan Leopold with Cobalt Mortgage. So, you start looking at the down payments, you start looking at these insanely low interest rates. Now, but the insanely low interest rates that you can find online are maybe not the exact same that you can find on an investment property.
Yes. So I think that's probably the biggest misconception that investors have when they're out trying to shop a mortgage. They're trying to see what new investors, until they understand the process, is they see posted interest rates online. And you got to understand that those are what I consider par pricing, par interest rates. So, for example, if we use an interest rate of, say, 3.5%, and that would be for a primary residence, single-family home, and you wanted to buy an investment property, you're going to always have an added fee for an investment property of 1.75%. And what that means is, if you're paying nothing to get, say, for example, 3.5%, you'd have to pay 1.75% of your loan amount in costs and points to get that 3.5%. Now, if you're getting a duplex or a fourplex, you're going to add extra premiums on top of that. So from an investor side, you have to look at that and say, do I get the lowest possible interest rate and pay all these points? Or is it better to get a higher interest rate and roll kind of the points into that interest rate and do it that way as opposed to money out of pocket?
And then
there's no right or wrong answer to that. It's just about understanding the options.
Yeah, and I think figuring out how long you're going to have that property. If you're going to try to pass it on to your kids and kids' kids and all the way down the road, that's different than maybe trying to find a screaming deal, fixing it up, and maybe selling it in a shorter period of time.
Absolutely. If you're not going to hold the property for a long time, even though interest rates are unbelievably low and we want to get as low as we can, you don't want to pay a ton of points if you don't plan to own the home for more than 2 to 5 years, own the property for 2 to 5 years. So it's all about looking at the numbers, kind of figuring out when that break-even point is, looking at your overall budget to see if it's worth it or not, or if those extra points can actually go to something that's more efficient inside the property, or there's a better use of the funds somewhere.
Yeah, I guess even fixing it up a little bit.
Yeah, absolutely.
Ryan, thanks so much for joining us. Stick around for a few minutes. We're going to bring Glenn Thiessen and Sarah Clifton back. We'll discuss more about investment properties here on this Thanksgiving week.